I covered Evolution Gaming in my stocks that are looking cheap for the month of July video. And since that video, Evolution has reported its earnings and the stock has dropped roughly 15%. The stock is also down over 50% from its all-time highs now, despite the business continuing to grow its revenues and profits extremely well. So in today's video, I want to discuss Evolution's most recent earnings report and explain why I think this stock is continuing to look very cheap, and why I think the drop after earnings was also an overreaction. But very quickly, earnings season has officially started, and companies like Google, Tesla, and Visa are all reporting their earnings this week. Amazon, Apple, Microsoft, and Meta will also be reporting in the upcoming weeks. And every earnings season, I do my absolute best to cover as many of the earnings reports as possible. So if you're not already subscribed to my channel and you would like to see my coverage of all the major earnings, then make sure to subscribe so you can see my videos as soon as they come out. And with that being said, let's now hop into the video. Alright, so I went through Evolution's most recent earnings report, its transcript, and its investor presentation to gather a bunch of different screenshots that I want to share with you in this video and all of the relevant metrics that I found. So right away, we can see here that Evolution's revenues increased by 15.3% year over year, its EBITDA increased by 11% year over year, and its earnings per share increased by about 2% year over year. So right away, we can see that the EBITDA and the net income are growing at a slower rate than the overall revenue, which means that Evolution's margins are contracting, at least in the second quarter. And that's kind of the story for this quarter, as revenue did grow strong, but profits are not following revenue right now. Additionally, we can see that Evolution also announced its capital allocation framework. It initiated a share repurchase program, and it announced that it is going to acquire Galaxy Gaming, which we are going to explore later on in this video. Down here in this table, we can see that Evolution's operating margin was 61.2% for this quarter versus 63.8% last year, so the operating margin did decline by 2.6%. The profit margin also declined by 7% year over year. However, the operating cash flow per share was up 34.2%. So Evolution's cash flows did grow significantly year over year, but the operating margin and profit margin did decline. So now let's move on to the CEO letter because they do explain why this is happening. And I have some underlying segments here. So right away, we can see that revenue growth on a constant currency basis would have grown at 19% year over year. So if there were no currency fluctuations, then Evolution's revenue would have actually grown by 19%, which is even stronger. We are intensively working on introducing our offerings to new markets that have recently regulated or are in the process of regulating, such as the Philippines, Brazil, and the Czech Republic. So Evolution is currently working on expanding into new markets that are opening up their regulations. Now also, if you don't know what Evolution's business does, then I would strongly recommend going and watching my July stocks that are looking cheap video, because in that video I dive into the business and what it actually does. So I don't really want to cover that again and repeat myself in this video. But continuing on, this says, we had the largest payout ever in online casinos during the quarter on our Crazy Time game. Large player wins are part of the game and positive for our game's attractiveness to players, but it does affect us through lower revenue share in the period. So how Evolution Gaming actually generates revenue is it gets a percentage of the profits that its B2B customers receive on their casino games. So basically, if their clients are paying out larger casino wins, or if there's a large time one casino win, then that will affect Evolution's Gaming's revenue to the negative side. Because if there's a larger casino win or a larger payout, then Evolution will have a smaller amount of profits essentially that it is taking. So since there was the largest payout ever in the most recent quarter, this is why the revenue growth decelerated slightly and also partly why its margins were down year over year. Additionally, the company says that after 2 quarters of heavily focusing on expansion, the second quarter was one of the consolidation with slightly lower margins as new resources were gradually coming up to speed. We expect a more normalized expansion of staff during the second half of the year. So since Evolution is expanding and opening up offices around the world right now, there is a larger upfront investment with hiring and setting up these new buildings and offices around the world. And then over time, as these offices actually start to generate revenue and net income and profits, then the profit margins should expand. But the story for this quarter was that there was a large one-time payment in terms of the casino. And then there was also Evolution setting up new office buildings around the world, which is harming margins right now. But for the rest of the year, they are expecting margins to start normalizing. And then down here, this last part is basically Evolution saying that they are maintaining their margin guidance for the full year. If we actually take a look at Evolution's increase in staff, we can see that it did grow by 21.2% year over year, as Evolution is hiring a significant amount more people and setting up new office buildings around the world. So in my opinion, this explanation actually does make a lot of sense. Now, continuing on through the CEO letter, this says, when looking at the global market, we see that the underlying growth drivers remain strong and vast potential in all of our regions. So overall, the tailwinds behind the business are continuing, and they are expecting that they will continue to grow over the long term. We are constantly looking for new ways to strengthen our position as a leading supplier of online casino games and have announced an offer for Galaxy Gaming. Through Galaxy, we gain a relationship with regulators in states that are not yet open for online and fast-track all future licensing. Galaxy holds over 130 licenses in the total worldwide. So this acquisition seems like it was more of a play for Evolution to get licenses and access to new markets. So instead of having to jump through all of the hoops and apply for these regulations or these licenses themselves, they can acquire this other company called Galaxy and get 130 licenses around the world and start operating in these markets. So it's kind of like a fast way to get access to new markets. Then Evolution also says, we will now distribute 100% of the excess net cash flow remaining after investments, including mergers and acquisitions, to support our ongoing operations. We will continue to pay a dividend of 50% of net profits annually, using the balance to repurchase shares unless an extraordinary dividend provides better shareholder value. The board currently believes that investing in our own shares is highly value enhancing to shareholders, and is initiating a buyback program of up to 400 million euros. So since Evolution's management believes that the stock is cheap right now, they are committing 400 million euros to buying back shares. And I do agree that this is a great way to start allocating capital to buying back shares, and it is a good time to start buying back shares as well, because I personally do think that the stock is cheap. Then the CEO also says, even though regulation is increasing the workload in many markets right now, it paves the way for a very strong future. Now, think about this. How does increased regulation in a market mean that a business's future could be much stronger? Now, in my opinion, it's because increased regulation actually means more barriers to entry into a market, which also means that more regulations that come could actually increase Evolution's overall moat, as increasing regulations could price out some of its competition or stop some of its competitors from wanting to enter a market. So basically, increased regulation can actually act as a moat for the companies that can get approved and get licenses in these regulated states or countries. So increased regulation can actually act as a barrier to entry and a moat for a business. Then finally, the CEO says we constantly have to move forward to be relevant 10 years from now and well into the future. And this is what I like about Evolution CEO, is they're always thinking long-term, and they're always thinking about the next decade, and they're not getting complacent, which is something that happens to a lot of CEOs, especially when a business has been doing well for a very long time. This is not the case with Evolution, at least in my own opinion. All right, now let's move on to Evolution's income statement right here. And the thing that I want to point out is that in the second quarter of 2023, Evolution had 217.2 million shares outstanding, and as of this quarter, they now have 211 million shares outstanding. This is a decline to the share count of 3% year over year. So over the past year, Evolution has managed to buy back 3% of its shares outstanding, and that is one way that the company is returning capital back to shareholders. Now, if we head over to Evolution's balance sheet, here we can see that the company has cash and cash equivalents of about $689 million and total current assets of about $1.57 billion. Now, if we take a look at the non-current liabilities, or the long-term debt essentially, they have around 405 million euros. Sorry, I should be saying euros. I'm so used to saying dollars. But the company has roughly 405 million euros of total non-current liabilities, and then about 715.6 million euros of total current liabilities. Now, why I think that this balance sheet is strong is because they have 689 million euros of cash, which is almost enough to completely wipe out the company's liabilities that are due within the next year. Additionally, the company has 1.57 billion euros of total current assets, which is enough to wipe out all of the company's liabilities and still have roughly 400 million euros left over. And this is just with the total current assets. So if the company wanted to, within the next year, it could become completely liability free and only have assets on the balance sheet. Now, I do not think that Evolution is going to do this, but I'm just trying to put in perspective how strong this company's balance sheet is right now. So now let's move on to the company's cash flow statement. And here we can see that operating cash flows were 313 million euros in the most recent quarter versus about 234 million euros last year, which is growth of about 34% year over year, as we already saw. Additionally, the company has done about 1.27 billion euros of operating cash flow in the trailing 12 months, which is growth of roughly 10% year over year in terms of trailing 12 months. Now, we can also see that the acquisition of tangible assets in the most recent quarter was 16 million euros, which is basically the company's capital expenditures. And this is only roughly 5% of the operating cash flow. So about 95% of operating cash flow becomes free cash flow for the business, which means that this business is a very profitable company and its capital expenditures are very low. Additionally, in the trailing 12 months, the company had 55.6 million euros of capital expenditures, which basically means that in the trailing 12 months now, the company has produced about 1.2 billion euros of free cash flow for its shareholders. In the most recent quarter, they also paid a dividend of 560 million euros, and the company pays a dividend once per year. So this dividend is only paid out once per year, and that is why the dividend payment is so high in this quarter. They also did not buy back any shares in the most recent quarter, but going forward, the company is expecting to buy back 400 million euros worth of shares, which basically means that on an annual basis, this company is returning roughly 1 billion euros back to its shareholders, which again is about a 5% net return to its shareholders from organic free cash flow right now. All right, now let's move on to the Galaxy acquisition and explore this a little bit. So right here, we can see that the total purchase price of the Galaxy company was $85 million, not euros, but dollars. Now, further on in this press release, this says, Evolution intends to retain the management and employees and also plans to operate Galaxy Gaming as a separate and independent business unit. So Evolution is actually acquiring this business and then is going to continue allowing this business to completely self-manage itself and grow on its own, which I do think is quite interesting, because this is what serial acquirers do. So there could be an argument that Evolution is starting to become a serial acquirer of businesses within the gaming industry. Additionally, down here, this says Galaxy Gaming has provided guidance of $29.5 million in revenue for this year and $12.5 million in EBITDA for the year of 2024. Now, what this means is Evolution is acquiring Galaxy Gaming for about 3 times revenue and about 7 times EBITDA, which is lower than what Evolution trades for on its own. So if Evolution can acquire this business and then also help manage the company better and increase its overall profit margins, then I do think that this could be a very accretive acquisition for Evolution as well, in addition to the company getting access to 130 licenses around the world and being able to expand its business that way. So now let's head over to Stock Unlock and take a look at Galaxy's business as well. And we can see that the business has been able to grow its revenue massively over the past about 14 years now. In 2008, it was doing $2 million in annual revenue, and it is doing $28 million in annual revenue now in the trailing 12 months, and the revenue growth has been quite consistent if we remove the COVID period. However, this company's operating cash flows have not really been growing, which means that its operating cash flow margin has not been growing, and it's actually been declining as the revenue grows. And this is what I mean. Evolution has very high margins, so I imagine that they are going to help Galaxy increase its margins and become a much more profitable business over time as well. So overall, I do actually like this acquisition, and I do think that it was a good move on Evolution, and I also think that Evolution is not paying an insanely high price, especially if they can help this company's profit margins grow over time. Now, I also found some of Evolution's larger competitors, and the ticker symbol for its largest relevant competitor, in my opinion, is CHDN, and the other competitor that is growing very quickly is GAMB. So if you want to take a look at these companies on your own, then I would recommend doing so, because I like to take a look at the competitors within the sector to try and get a better understanding and idea of the business that I am taking a look at. So right here, we are taking a look at the revenue growth of these 3 businesses since about 2017. And we can see that CHDN has compounded its revenue at 23.4% annually, Evolution has managed to grow at 46% annually, and GameB has grown its revenue at about 53% annually. However, it is worth noting that GameB is only producing about $111 million in annual revenue right now, so it's working off of a much smaller base. But Evolution and CHDN are much more comparable businesses. Now, if we also take a look at these businesses' operating income, we can see that Evolution is producing the most operating income right now at about $1.3 billion, and then CHDN comes in second at $600 million. Evolution has also grown its operating income the fastest because the company is the most profitable by far. In fact, if we take a look at these businesses' operating margins right here, we can see that Evolution's is 63%, CHDN's is 24%, and then GameB is only 21%. So Evolution is the most profitable operator in this sector by far. And one metric that helps you identify if a business does have a moat is if its profit margins are significantly higher than its competitors. And in Evolution's case, it does have a significantly higher profit margin than all of its peers within the industry. And this is one of the reasons why I think that this business does have a moat and is also the leader within this industry, because no other company can touch its profit margins. So now let's take a look at the price to operating income of all of these businesses. And right now, Evolution is trading for about 16.4 times operating income. CHDN is actually trading for the highest at 17 times operating income, and GameB is trading for about 14 times operating income. So relative to the sector, Evolution is actually not trading for an insane price ratio either. Now, if we get rid of these two other competitors and we take a look at Evolution on its own, and let's zoom out all the way to 2015. So here we can see that the company's long-term historical average price to operating income ratio has been 31, and currently it is trading for about 16, okay? And this is actually the lowest the company has ever traded for. So the company is quite literally trading for the lowest price to operating income ratio it ever has, and it is trading significantly below its averages at about 50% of its historical averages as well. If we take a look at the company's price to free cash flow and zoom in here, we can see that its average has also been 38 since 2017, and it's now trading for about 18 today, which I think is a pretty low price to free cash flow for a business that is growing its revenue at 15% annually. And also, additionally, it's less than half of the company's historical averages. So when I take a look at this company's historical average price ratios, I see that it is trading for about 40% of its historical averages, which could suggest that the stock is looking quite cheap. And additionally, when I take a look at the business's price today just on its own, of a price to free cash flow of 18 with 15% annual revenue growth, I do think that that is a pretty attractive price ratio as well. And that is also why I think that this stock is looking quite cheap. It is a very profitable business with crazy high profit margins. It has also been growing its revenues and its operating cash flows and its operating income consistently at very high growth rates for years. It's also got a very strong balance sheet, and it is trading for all-time low price ratios and still growing the business. And I think that makes a pretty compelling story for this stock. Now, the last thing that I want to do in this video is play around with our discounted cash flow calculator over at Stock Unlock to kind of show you what the market is currently pricing in for this business and what the returns for this business could be over the long term as well. So we're projecting out Evolution's free cash flow over the next 5 years, and I'm saying that free cash flow is going to grow at an annual rate of 10% going forward, which is well below the company's historical average growth rates and well below the company's revenue growth of 15% right now. So I think that this is actually a pretty pessimistic free cash flow growth rate over the next 5 years for this business. I am also saying that the business is going to buy back roughly 3% of its shares on an annual basis going forward, because they are buying back shares at this rate right now, and they did just renew another buyback program of 400 million euros, which should be another about 3% buyback over the next year. I'm also saying that the dividend will grow in line with the free cash flow, and the company will only trade for a price to free cash flow of 15, which is actually below where it is currently trading. And when we put in these metrics right here, we get a compounded annual growth rate to the stock of about 15.5%. This is a market-beating return right here on what I believe are actually pretty pessimistic numbers for this business. This also adds to my explanation as to why I think that this stock is looking cheap, because again, when I put in pretty pessimistic numbers for this stock going over the next 5 years, we get a market-beating return in our DCF. Now, the next thing that I want to do is put in what the company has to achieve to produce a 10% compounded annual growth rate to its share price, which is the historical average of the S&P. And the number right here is a 4.2% annual growth rate to the free cash flow over the next 5 years, and maintaining a 15 price to free cash flow, which I do think is still a pretty low price ratio for this business. So this is what the market is currently pricing in. Now, if we also scroll down, you can kind of see what this looks like going forward. So this is Evolution's historical free cash flow right here. You can see how strong its growth rates have been. And the market is currently pricing in this growth to essentially just completely slow down, decelerate, and only grow at 4.2% annually over the next 5 years. This would be a massive trend change to the company's overall historical free cash flow growth rates, and I personally do not really see this happening. I think that this is pretty bearish, and I think that the market is actually being overly bearish towards this stock. So let's see if the company can actually grow its free cash flow at 12.5% annually and maintain a 20 price to free cash flow. In this scenario, the stock could achieve a compounded annual growth rate of 24%. And this is kind of more on the optimistic end, but I also think that this isn't too optimistic. And in my opinion, this is why the company is looking quite cheap today. Because even with kind of optimistic numbers, the stock could produce some pretty dang solid results over the next 5 years. So it really just comes down to, can this business actually continue to grow its free cash flow at around 10 to 12% annually? Can it continue to buy back 3% of its shares annually? Can it continue to pay a dividend? And can it continue to trade for a price to free cash flow of 20, which is still well below the company's historical averages? And in my opinion, these are not crazy metrics right here. And I do think that the company can achieve these metrics right here as well. And if it can, then it can also produce some pretty solid returns over the next 5 years. So for all of those reasons, I think that there is a strong argument that Evolution is looking undervalued in the market right now. I also think that the market is overreacting to its most recent earnings report, and I do think that this could be looking like a cheap stock in the market today to research more and add to your own watch list. I personally have not put Evolution in my own portfolio yet because I still want to research more about its moat and build my conviction on the moat of this business and why it truly does have a competitive advantage. But if I can sort out the moat and come to a conclusion on the moat of this business on my own, then this is a stock that I am looking to add to my portfolio in the near future. I really just want to answer that question and build my conviction around this business's moat. So if you have any additional information or what your opinions are on the moat, then please let me know down in the comments section because I will be reading the comments of this video. So if you could help enlighten me around this business's moat, then I would truly appreciate that. But with all that being said, that is going to wrap up the video for today, everyone. And I really hope that you did enjoy this one. This was kind of a little bit more of a deep dive, but this is the research that I do for the stocks that I put in my portfolio. And I hope that you learn and enjoy the overall analysis. If you did enjoy the video, please remember to leave a like on it as it really helps out my channel. And if you want to see more earnings analysis over the upcoming week with Google, Microsoft, Meta, all the major companies, then make sure to hit subscribe as well, because I do my best to cover as many as I possibly can on my channel. But with that being said, again, that's going to wrap up the video, everyone. So thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in the next one.